Suhail Chandy, Bank Investing, a Practitioner's Field Guide. Embark on a journey through the labyrinth of bank investing with Bank Investing, a Practitioner's Field Guide by Suhail Chandy. Prepare to unravel the complexities of bank financial statements, where metrics like return on assets, ROA, and return on equity, ROE, serve as critical indicators of profitability. This guide equips you to navigate vital concepts such as asset quality, liquidity, and sustainable growth, all crucial for evaluating a bank's health and potential. Delve deeper into credit analysis, loan portfolio composition, and the nuance of regulatory environments. Explore the intricate dance of mergers and acquisitions within the banking sector, revealing how economies of scale and compliance costs drive industry consolidation. This concise summary offers a robust framework for making informed investment decisions in the dynamic and ever-evolving sphere of bank investing.
Navigating bank financials. Picture yourself in a labyrinth of numbers and ratios, where each turn could lead to either triumph or downfall in your investment endeavors. This is the world of bank financial statements. Although navigating this maze calls for unique tools and a sharp focus, understanding these documents can guide you on your financial journey. At the core of this exploration are two pivotal metrics: return on assets, ROA, and return on equity, ROE. ROA emerges from dividing a bank's net income by its average assets over a specific period. Picture it as the bank's muscle, showcasing its ability to leverage assets profitably. On the other hand, ROE measures efficiency, highlighting how well a bank converts its equity into profit. Both metrics illuminate a bank's profit potential, making them essential references when deciding on investments. These figures are your compass in assessing the true profitability of financial institutions. Turning the spotlight onto an often overlooked factor, we encounter asset quality. Meet Sarah, an insightful investor comparing two banks with similar profitability. She uncovers that Bank A carries a significantly higher ratio of non-performing assets, NPAs, to its total assets compared to Bank B. This discrepancy signals potential risk, prompting Sarah to opt for the safer choice, Bank B. The lesson here: examine asset quality vigilantly. NPAs can reveal the level of risk a bank is shouldering and signal possible future credit complications. Liquidity is another cornerstone in the banking realm, often as vital as air. Consider the loan-to-deposit ratio, which compares a bank's loans to its deposits. A high ratio indicates a potential over-leverage situation, while a low one might point to inefficiency. Visualize it as caring for a plant. Balance is crucial. Too much or too little water, and in a bank's case, liquidity, can hinder growth. Speaking of growth, sustainable growth should be your focus. Like any business, banks thrive on expansion, but rapid loan growth poses risks. If Sarah notices Bank C's loans soaring swiftly, she needs to pause and assess the sustainability of this trajectory. Reckless growth could lead to instability. The growth rate should align harmoniously with that of other banks to ensure long-term health. Thus, bank financial statements are more than spreadsheets, they are the institution's blueprints. These documents reveal profitability, operational strategies, risk management, and sustainability. By dissecting the key metrics discussed, you're not just staring at numbers, you're unraveling a narrative that can steer your investment strategies through the complicated and intriguing maze of banking. The investor's bank journey. Picture diving into the intricate world of bank investing, where numbers such as return on assets and return on equity act as navigational guides. Yet, to truly master bank investing, one must explore beyond surface-level metrics and delve into the subtleties of credit analysis and loan portfolio composition. This perspective offers a richer understanding, transforming stark numbers into nuanced insights. Begin by scrutinizing loan loss reserves, which banks earmark to cover potential bad loans that could default. It's not simply about having larger reserves, rather, it's finding the right balance. Banks exist in a constantly shifting environment where regulatory and tax conditions evolve. Excessive reserves might indicate missed lending opportunities, whereas insufficient reserves elevate default risks. As an investor, it's vital to study historical trends. If you notice abrupt changes in a bank's reserve calculations without correlating shifts in regulations or market conditions, consider it a warning sign. Next, understanding credit quality becomes crucial. It's essentially the heartbeat of a bank's operations. Given the leveraged nature of banks, even minor increases in loan defaults can severely impact their stability. To gauge credit quality, focus on indicators like the Texas ratio and net charge-offs. The Texas ratio measures the proportion of non-performing assets to a bank's loan loss reserves and tangible common equity, which represents hard capital readily available after excluding non-liquid assets. A high ratio signals potential credit risk, a significant red flag. On the other hand, net charge-offs reflect the proportion of loans a bank believes will remain uncollectible relative to its loan portfolio. Rising net charge-offs often hint at declining credit quality, serving as early warnings of potential problems. Accounting practices also play a pivotal role in shaping perceptions of a bank's financial health. Consider the current expected credit loss model, CECL, designed to enhance responsiveness of loss allowance estimates to economic fluctuations. Any sudden shifts in a bank's accounting approach warrant closer inspection. Has the bank adopted CECL, and what are the resulting impacts on its loan categories? Fully comprehending these dynamics is essential, as CECL influences can resonate throughout the bank's operations, particularly affecting consumer loans. In the grand narrative of bank investing, credit analysis and loan portfolio composition bring essential depth, transforming raw numbers into a compelling story. By honing your understanding of loan loss reserves, credit quality, and shifts in accounting practices like CECL, you become adept at reading beyond numbers. This deeper insight serves as a narrative guide, empowering you to make informed investment choices in the complex world of banking. Mastering bank investments. Venturing into bank investments can feel like walking on a financial tightrope, but grasping core ideas like regulations and interest rates can be a valuable anchor. Capital requirements lay the groundwork for a bank's stability, acting as a cushioned net to absorb potential financial pitfalls. Regulatory bodies, such as the Federal Reserve and the Office of the Comptroller of the Currency, utilize the CAMEL system to assess a bank's strength across key categories: capital, assets, management, earnings, liquidity, and market sensitivity. A robust CAMEL's rating can signify a well-managed bank, making public disclosures of these ratings a crucial consideration for investors. Transparency in this domain frequently suggests a safer investment choice. Stress testing is another significant tool that underpins a bank's resilience. Much like how an investor might simulate various economic scenarios to gauge the impact on their portfolio, banks engage in similar exercises to predict their performance under severe conditions, such as sharp interest rate hikes or economic downturns. These tests become mandatory for banks surpassing the $10 billion asset mark, introducing a new set of challenges and regulations. As potential stakeholders, paying attention to how banks adapt after crossing this threshold is essential, avoiding the risks akin to holding a financial hot potato unprepared for these evolving regulatory demands. Interest rates, comparable to the shifting tides of an ocean, influence a bank's earnings landscape profoundly. Rising interest rates generally boost a bank's loan earnings beyond the interest paid on savings, whereas lower rates can compress profits. Investors should keenly monitor Federal Reserve announcements on interest rates, as these indicators can dramatically sway bank stock values. Diving into the broader economic cycles offers foresight into these rate changes, equipping investors with a tactical advantage over time. Additionally, the 2018 Economic Growth Act redefined the asset levels which prompt additional government oversight. As banks border on asset thresholds like $50 billion or $250 billion, their regulatory environments and compliance expenditures could pivot drastically. Recognizing these shifts is pivotal for investors anticipating changes in performance and financial obligations. Unpacking the nuances between bank regulations and interest rates is more than just mastering information meant for Wall Street insiders. These elements directly influence bank stability and profitability, ultimately impacting investment returns. By delving into capital requirements, stress tests, and interest rate dynamics, investors arm themselves with knowledge, enhancing both their awareness and potential success in the banking sector. The M&A Playbook. Picture the intricate world of bank mergers and acquisitions. You're familiar with the basics: financial statements, credit analysis, regulation, and interest rates. But when you step back, how do these elements weave into the larger tapestry of the banking industry? Since the 1980s, the landscape has shifted dramatically, marked by a significant drop in the number of bank charters. This consolidation signifies more than just a passing trend. It signals a formidable shift in the industry's dynamics, driven largely by economies of scale and overwhelming regulatory costs that smaller banks struggle to bear. For investors, the implications of these changes are profound. Spotting banks that are attractive acquisition targets can offer potential outperformance compared to standard benchmarks. However, the playbook of mergers and acquisitions isn't just about identifying potential buys, it's about understanding deal structures, which vary widely. Take whole bank acquisitions, for instance, where a bank takes over an entire entity, assets, staff, and more. While this strategy offers rapid growth, it carries the risk of inheriting concealed problems. Contrast that with FDIC-assisted deals, where the U.S. Federal Deposit Insurance Corporation assists a healthy bank in absorbing a failing one, reducing the acquirer's risk. Navigate these complexities effectively, and you'll recognize the pivotal role of post-acquisition integration. Successful mergers don't just happen, they require strategic execution. Here, the nuances of cultural alignment, technological harmonization, and enhancing customer experience are crucial. When done right, these factors transform the merger equation into one where the sum is greater than its parts. In this evolving sector, understanding mergers and acquisitions isn't confined to theoretical business discussions. Instead, it serves as a practical guide, a toolkit filled with insights on economies of scale, compliance challenges, and the subtleties of transaction types. Whether you're a burgeoning investor or a seasoned stakeholder, staying ahead in this continuously consolidating and regulatory-laden environment is not merely advisable, it's indispensable. Equip yourself with this knowledge and navigate the banking sector's M&A realm with precision and insight, turning complexities into strategic advantages.
In the ever-shifting world of bank investing, Suhail Chandy's guide empowers you to decode financial statements and grasp the nuances of credit analysis and regulatory impacts. The book emphasizes the significance of scrutinizing metrics like ROA, ROE, and asset quality while understanding liquidity and sustainable growth. It sheds light on the banking sector's consolidation trends, where mergers and acquisitions reshape the landscape. Armed with these insights, you'll be better equipped to assess investment opportunities, foresee challenges, and navigate economic cycles wisely. This guide transforms complex data into a compelling narrative, offering you the knowledge to invest confidently in the banking industry's unpredictable terrain. By mastering these aspects, you're poised to make informed decisions that align with the ever-changing financial and regulatory environment.